Welcome back. Earlier this week, the Philly Fed index was released at a level of -9. And what we're going to see in a moment is that the current situation of manufacturing in the Philadelphia region is continuing to place a strain on producers. What this is a survey measuring the change in business growth, specifically in the manufacturing district within Philadelphia. And we're at a level of -9 currently. Now we see here the general activity on the left-hand side. That's the overall number, -9. Then we break it down by inventories, -7, unfilled orders, -16.8. Now the numbers represent whether the industry is contracting or expanding. Positive numbers are obviously better. In particular, notice prices paid. These are the prices that are paid by the manufacturers, up 23.1. The prices received is up to a level of 14.6. And this is the issue, that the manufacturers are paying more than they're able to charge the customers. This is something the Federal Reserve has actually mentioned as a concern. Year over year, the inventories have risen 250%, which is not really good. We don't want to see high inventories because it means there's a lack of demand. The work hours year over year down 148%. Now, prices paid down 48%, prices received down 57%. So the amount that the manufacturers are able to charge for their finished goods is less than the inflation that they have to pay for the raw materials. Now we see this is going back to 2007 through 11 and focusing in on the financial crisis of '08, '09. We see here that, these numbers move down quite a bit. The brown dotted line, that's prices paid. The purple dotted line is prices received. Now, prices paid during an inflationary period certainly was higher, but then when we went down, we all went down together. What we're going to see in a moment is that's not the case now, that we're still working through a tremendous amount of inflation, especially on the prices paid level. So we see here, present day, the prices received is the purple dotted line. The prices paid is the brown dotted line. And what we see is that there was quite a bit of inflation in the sense that there's a gap between prices paid, prices received. The larger this gap that we saw 2022 shows us the inflation is hurting the manufacturers more than the consumers. Now, why is this important? Because manufacturers their profits are reflected in stock earnings, in corporate earnings, things of that nature. So when we see a large gap, yeah, maybe it means in some respect that the consumer is not paying as much, but it's not that the consumer's, getting a discount. It's that the consumer cannot afford the inflation that the manufacturer is forced to pay for the raw goods and goods on the manufacturing side. Here we see the 100-month correlation to the S&P 500. Current inventories, a 27% correlation. Current worked hours, 29%, not huge. The biggest correlation is prices paid, 59%, prices received, 63%. And this is important because as we run into stock market weakness, we would, especially as of late, we'd see very, very weak stock prices. We would also expect this to carry over to prices paid, prices received, meaning that the manufacturers cannot afford to pay for the inflationary raw materials, and the consumers cannot afford to pay for the inflation that we see in the finished product. Here is prices paid in red versus the S&P 500, and we see, a positive correlation up until recently. When the prices paid went down, the S&P 500 did not. Maybe the recent weakness is going to, return to this correlation. Here's prices received now, and what you'll notice is a much bigger dip on the prices received. Again, go back to prices paid, and we'd see a little dip over here down to the 2,800 level. Prices received, a much deeper dip down to 2,300. So we see that there's certainly, there was a correlation in the S&P 500, but the prices received, this is the ability for the consumer to pay for these finished goods. The ability is not there. And finally, we see here the red histogram bars again is prices paid. That is what the consumer or what the manufacturer has to pay for the raw materials. Prices received is what the manufacturer is receiving from the consumer. We cannot afford as a consumer to pay for these inflationary products, at least not with the same quantity. And that's why this yellow line is lower than the red line. And until this resumes, this will put a strain on the manufacturers, on their earnings, and I think eventually that will be reflected in stock prices as well, and the corporate earnings are released on a quarterly basis. So, not really good news, and I think it has far-reaching ramifications. But we're going to continue to watch this closely, and we'll report any significant changes along the way. We hope this has been helpful. We look forward to seeing you back soon.